You've worked hard to earn and save. Now it's time to make your money work hard for you. This is Empower Your Retirement with Frank and Frankie Guida of A Better Way Financial.
Guys, the headlines, the conversation about tariffs have obviously been front of mind for many savers, particularly when we think about how it's going to affect our bottom line. Some of the tariffs have been reduced or removed as trade deals evolve. Many are still in place. So when could we feel their impact on what we buy? Economist Jeremy Siegel tells Fox Business he is looking at right now, summertime, and that the Fed should sit still. Here's what he said.
I don't think we're going to be seeing the effects of this tariff until maybe June or July. This is tariff-induced inflation. Long-term inflation rate indicators are not going up, and the Fed should not be reacting against a supply shock. It should be reacting against a demand shock, and we're not getting a demand shock either from the tariffs or the fiscal policy or money supply growth.
Guys, Wall Street is so reactive to information like this. If you got out of the market in April because of fear of tariffs, you might be regretting that now. What do you say to somebody, particularly a client, who comes to you and starts talking about things in the way of timing the market?
You know, Heather, I got to tell you, it's kind of rare with our company that happens.
Okay.
And the reason is because we really explain to people how things work. You know, we sit down and we tell them, we show them, we show them the graphs of the stock market. Usually we're taking the graph from 2000 to 2025, the last 25 years, because we've had 2, maybe 3 really significant stock market drops, and we go through those graphs and we're showing people, we tell them, look, we want to put some money in the stock market. Why do we want to put some money in the stock market? Because over time, it's been our best return. Okay. It really has. And we show them the ups and downs. And what happened every time the stock market went down? It went back up. The fear factor probably shouldn't be quite what people have. So when we're looking at, that it goes down. Now, and I said to them, well, if it goes down like this, right, and then you sell before it goes up, what didn't happen to your money? Your money didn't go up.
Yeah. Yeah.
So we need to find a way in which the people can have the stock market returns without worrying so much about the ups and downs. So what we do is we show them that they really should have some safe money in addition to the money at risk.
Yeah, and studies have shown time and time again that when you try to time the market, you usually underperform the growth of the market. So it's not something that you want to emotionally look in and say, oh, well, my money's going down, let's get out now. Mm-hmm. Or, oh, well, the market's done really well, now's a good time to invest. Because usually it's the exact opposite. So you don't want to try to time your market. You want to have your portfolio set up for the long term so that when these blips happen and when these major market crashes happen, you're going to be protected and you're not going to go down more than you feel comfortable with. So that's why it's super important to make sure that you have a strategy in place to protect yourself when those major market crashes happen. Now, what we do is we look at, well, what are those alternatives? What are the safe money alternatives that you have in your portfolio? Some people have those target date retirement funds, which as they get closer to that date, that 2025 or that 2030 or 2035, they put more and more bonds in the portfolio. And what they're assuming is, well, these bonds are going to make it less risky. Now, what usually happens is when the interest rates are going down, it's a good time to invest in bonds. And this is what we have seen from really the 1980s, 1990s to 2010s, early 2020. But over the past 5 years here, the interest rates have actually been going up, making bonds a very bad investment choice where you can lose money in those bonds. And so what we've seen is people who are invested in bond mutual funds or in individual bonds, if they're not held to maturity, have actually been losing value on those bonds. So it's something that we take an alternative approach. We don't want to put our clients into these bonds that could be losing money if the interest rates continue to climb. So it's something we look at, well, what other alternatives do we have? And those alternatives we have are something called fixed indexed annuities. And we basically utilize those to replace the bond allocation within the portfolio. There's other no market risk options. There's cash, there's CDs and treasuries and things like that, but they usually don't perform as well as the fixed indexed annuities, which The way that they work is you gain money when the markets go up, but you don't lose any money when the stock market goes down. How do we get a steady potential for growth without any major market risk? So within that portfolio, we look at, well, how do we balance it? And we utilize the safe money portion. We have the fixed index annuities, and then we utilize the market for the rest of the portfolio. And to determine how much we have in each of those, we figure out, well, what is your personal risk tolerance? What is your comfort level with stock market risk? If you're not very comfortable, then that's less money you have in the market. If you're very comfortable, then that's more money you're going to have in the market. We design it personally and tailor-made for you. So if you haven't had that analysis done, if you don't know what level of risk is in your portfolio or what level of returns you're currently getting, give us a call for your complimentary portfolio x-ray, where we're going to be able to show you exactly what that level of risk is associated within your portfolio, as well as the returns from the year 2000. We'll also be able to show you alternative options available. Design a custom-made portfolio within your personal risk tolerance. So if you're 55 and older and you save $500,000 or more for your retirement, give us a call right now for your complimentary portfolio X-ray, which is going to be available right now for the next 5 callers. And that number to dial is 610-440-3722. That's 610-440-3722.
You know, it kind of reminds me of that couple that came in from Kutztown. They had come to one of our dinner seminars, and nice folks. They were already retired, 70 and 69. They had 3 kids, a couple of grandchildren. You know, they had Social Security, they had pensions, and they had $1 million portfolio. Mm-hmm. These folks, you know, were doing good. You know, they weren't so sure, and they were a little afraid of the market. You know, they were looking at their portfolio, and it looked like it had a lot of volatility in it too. You know, they wanted an income of about $95,000 a year. So we did our normal retirement planning and our tax planning, which helped them. And then we made recommendations about their portfolio too, didn't we, Frankie?
Yeah, they were in a moderate aggressive portfolio. And over the past 25 years, they were averaging about a little less than a 7% rate of return, about a 6.8% return. And then the drawdown on that, or maximum they could lose in a 2008 type scenario, was around 36%, which was a lot more than what they felt comfortable with. On their $1 million portfolio, they could have lost up to $370,000. And when we discussed that and the level of risk associated with their portfolio, they just didn't feel comfortable with that level of risk. And we showed them how they could also have a moderate portfolio, but we can lower some of that risk associated with it down from it being able to go down as much as 36% to 23%. So taking about half of the overall risk of the market while increasing their rate of return. So this is going to make a huge difference as far as how we could set up that portfolio within their risk tolerance and getting a rate of return even better than the higher risk portfolio that they were currently in. We looked at how to get their portfolio set up and how much income they're going to be able to get in their retirement. We showed them that by doing the proper planning, we could increase their income, that they were getting $95,000 of income per year, all the way up to $188,000 of additional income coming in each year for the rest of their lives. That's almost $100,000 more. Wow. Of income to be able to spend at their discretion, the way that they want to. They had big goals in their retirement. They wanted to travel. They wanted to do some of the things that they hadn't gotten to do while they were working. They worked so hard, and we just showed them. We said, hey, let's make the most of this money that you saved. You can't take it with you. Let's enjoy it. Let's make sure that you're doing the things that you want to do. Let's write that bucket list out that you want to do, and let's cross it off. Let's make it happen. And they were really excited to be able to see that they could spend even more than what they were currently spending and not have to stress or worry about running out of money in retirement. So if you don't know how much income you can live on, if you don't know if maybe you can spend more money in your retirement years and you want to learn that information, well, give us a call and we'll do a complimentary portfolio x-ray for you, where we're going to be able to show you what level of risk is associated with your portfolio, what level of returns are you getting, as well as some alternative options and a custom-made retirement plan where we're going to be able to show you how to maximize your portfolio in retirement. So if you haven't had that done and would like to get that done today, we are offering that right now for the next 5 callers. So if you're 55 and older and you save $500,000 or more, give us a call at 610-440-3722. 3722. That's 610-440-3722.
Thanks for listening to Empower Your Retirement with Frank and Frankie Guida. To learn more, visit abetterwayfinancial.com.
By contacting us, we'll review aspects of your retirement portfolio to include suggestions about how best to utilize estate, tax, and retirement planning strategies and other financial services, or if changing management styles is appropriate for your specific needs and objectives. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendations to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. A Better Way Financial is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client, and they are not meant to imply or suggest you will experience the same results. Advisory services offered through A Better Way Financial. Insurance offered through licensed professionals at A Better Way Financial. Pennsylvania Insurance License number 301779.